us. I hope everyone's doing well and they're safe and healthy. This is our second webinar going through our fifth COVID Insights report. So for those of you that aren't familiar with dv01, we are data reporting and analytics platform. We're connected. You could think of us as a data hub in the center of the markets, receiving data from all the different originators and issuers in the online lending space and making that data easily accessible with all the reporting and analytics tools built on top of it for originators, investors, anyone involved in the markets. We got started on these reports fairly early when everything started based on the real-time data that we receive for all the securitizations that we report on. And this is a one-of-a-kind data set that we've been reporting on and giving you updates on how the consumer unsecured space has been performing to date. I want to thank you for all the feedback we've been getting, the questions we've been getting. Everyone's had their hand in helping make these reports better and more useful. And I want to specifically thank the team at dv01 for putting these together, specifically Vadim and Wei, who've spent a lot of time and energy putting these reports together for you. So I don't want to take up too much time. I'll let Vadim kick this off. And if you're not familiar with Zoom, at the bottom, there's a Q&A button. You could post any questions that you have in there, and we'll leave some time for Q&A at the end of the call. So with that, Vadim, take it away.
Yeah, thanks, Perry. Welcome everyone to our second webinar, as Perry said, which is covering our most comprehensive COVID-19 report to date. The full copy of the report can be found on our website or by contacting our sales team. Roughly, I'll run through the agenda, which is focused on two segments, the online lending world, as well as the mortgage world, which we then subdivide into non-QM versus CRT. In online lending, we're going to be focused on specifically impairment, delinquency, modification, and modification trends. We'll also be talking about performance by collateral attributes, as well as talking about the issuance volumes that we've seen since COVID has started. And in non-QM and CRT, we'll be talking about some of the same impairment, delinquency, modification trends, as well as performance by specific attributes. And in mortgages, we'll also be discussing the initial prepayment trends that we've seen coming out of the COVID virus. Before I go on, I want to talk about some terminology that we'll be using throughout the call. And a lot of this is terminology many of you are familiar with. The term delinquency simply means any loan that is currently past due and not in an active modification. We define past due in online lending as any loan over 0 days past, and in mortgages, any loan over 30 days past. Now, we define modifications for this report as any change, whether temporary or permanent, that are made to the terms or payments of a loan. And we also include any offers to temporarily pause making loan repayments. In both of these cases, borrowers must contact issuers or servicers directly and request this modification. Nothing currently is being offered automatically. And finally, the term payment impairment, which will be focused on the most throughout the report, is a sum of loans that are either delinquent or modification, or in modification, so think of it as a combination of both. And briefly starting with the size of our data set for online lending, we're covering over 1.7 million active loans in this report, with balances of well over $19 billion. The data, which is very current, is updated through May 24th, 2020, and is provided based on loans that are given to us on a daily basis. Now, what's additionally important to understand here is any loan that meets this criteria and reports on daily is automatically included. We don't do any filtering, and we don't do any exclusions. Now, we have a rough set of the collateral attributes of this universe here, but to let investors and all stakeholders gain a much better understanding of this sector, dv01 is shortly releasing an anonymized and aggregated consumer unsecured benchmark dataset. That's coming over the next couple weeks. Please contact our sales team at sales@dv01.co for more information. And now, without further ado, on to performance. And there has been some very positive trends in impairment and performance that we've seen throughout the month of May. After impairments peaked at around 16.5% at the end of April, they've actually been coming down throughout the month of May, as we see in figures 2.1 and 2.2. The final number as it stands today is that current impairments are about 16%, which is up about 1,000 basis points or 10% for their historical norms. Now let's compare that to unemployment. The adjusted unemployment rate reported by the Federal Reserve, the Bureau of Economic Research, came in at 19.5% in April, which is a 1,600 basis point increase from February. On top of that, there's been an additional 7.3 million initial jobless claims filed in May, even as the impairment rate in Marketplace has actually been going down. And what we noticed is that overall impairments really began to flatline after around April 20th, and they began their earnest decline throughout the month of May. And we can see this behavior a lot more clearly when we look at new impairments, which have actually been running in May well below historical normals, as we see in figure 3.1 and 3.2. And this behavior we also noticed really occur as of the second week of April. And in fact, the initial spike that we always see in the beginning of the month when the vast majority of loans comes due was actually lower in the month of May than in any month since at least the start of 2019, and actually going back even further. Now, when we further subdivide this impairment universe into its components of delinquencies and modifications, we see that the delinquency rate has actually now hit multi-year lows. Now, this obviously avoids any near-term concerns about losses for investors, as these loans are now in a modification, and it also shows this tremendous effort that all issuers have made in ramping up their mod efforts. Mods have gone from being a very insubstantial portion of all impairments before COVID to now representing over 75% of those outstanding. And even modifications have flatlined, as we'll be going through in the next chart. So this has roughly covered performance to date. And what we want to focus on for the remainder of the marketplace sector is to understand what these modifications might look like as they start performing and what the performance has been so far. So what we can see is that as soon as COVID ramped up, issuers began to earnestly expand or offer new modifications to help borrowers in these trying times. Mods rose almost immediately, and in fact, 65% of all modifications occurred between March 25th and April 17th. And since that day, since that week, mods have been coming down every week by a substantial amount, where the last week of May 17th actually represented by far the lowest totals to date. Now, a chart that's not in this particular slide, but is in our report, and you can find it in figure 6.4, shows that of all modifications done, over 90% of them were a form of temporary pause of all payments, with the terms of that roughly broken out between one month of pauses and 2 months of pauses, representing over 90% of all loans. But even this comes with a caveat, because all the short-term programs, the 1 and 2 months, once that deferral period comes up, if the borrower's economic circumstances still maintain, as they do in today's environment, they can request further extensions. And that covers what the modifications have been, but we've already seen substantial payment behavior, as we see in the next slide. In fact, almost 25% of all modified loans have actually begun to pay out their loan and resume normal payment schedule. And that's up from only about 200 basis points at the end of April. And even further breaking that down, that number rises to over 30% of all the loans modified after March 29th, which, as we talked about, is the majority of all modifications. But again, even this doesn't tell the full story, because as we mentioned earlier, only about 50% of loans have a 1-month payment period and 50% have 2 months or longer. So when we just look at that 1-month loan program, here the payment rates jump even more. Over 50% of all 1-month modifications made their first payment immediately after the modification ceased, and in fact have actually begun to go back to normal payment schedules. And that number rises to over 80% after the second month, as we see in the orange line in this chart. Now, what's not exactly immediately visible, but what's even more encouraging, is that the earlier than 30-day payment rates have actually been going up every single month, every single week. And in fact, some of the latest modifications already have almost 10% of loans resuming payment even though they haven't even had to yet. And obviously, as we think about this payment behavior, and as we think about future defaults, it's very encouraging that over 50% of borrowers have actually gone back on a normal payment schedule. Now, moving on to specific performance by attributes, we've been highlighting that certain regions have been much harder hit since COVID-19 has started. And that's clearly played out in performance impairments, which have risen in the New York tri-state area and California, and in particularly in the tourist states of Florida and Nevada and Hawaii, well in excess of the overall rise in other states. Now, what is very encouraging is that every single region, except those tourism states, impairment rates have actually begun to come down. And even in those specifically hardest hit regions, there is some hope. Because keep in mind, Nevada's unemployment rate actually reached 28% in April. That's up from 3.5% in February. So almost 2,500 basis point increase versus the increase we're showing, which is just under 2,000 basis points. So even in an environment where the road to recovery looks the most difficult, where travel restrictions are still in place and hotel occupancy rules are still very, very limited, it's clear that borrowers are doing what they can to stay ahead of their debt payment schedule. And probably the most important determining factor in performance has in fact been some of the issuer underwriting standards. Now, these underwriting standards were obviously put in place well before COVID, and they couldn't have possibly anticipated how much damage COVID has done. But even still, it's very encouraging to see the behavior that we've seen. By far, the lowest overall increase in impairments and the largest decrease has come in the top grades, which represent 40% of all issuance, while the bottom grades, where impairments have risen by over 1,500 bips, have not yet shown a plateauing, although the rate of increase has substantially gone down. Now, what's very important to keep in mind about this slide is that every single issuer has loans present in all three grades. So despite the fact that each different issuer has a different way that they underwrite and different collateral characteristics, each one of them has this grading system in place. So each category represents loans from everybody. Now, moving on to some other attributes that we found notable. And it's very clear that borrowers who are homeowners have performed substantially better than those who aren't. The impairments grew much less, and then they've also decreased substantially. And we want to delve into this a little bit better. So homeowners clearly need to maintain strong credit profiles in order to take advantage of the low rates that we're seeing in the mortgage environment today and refinance their primary source of debt, which is the mortgage. Especially as they're able to do that and they're able to lock in some lower rates, homeowners can really take advantage of the current environment to be able to substantially reduce their debt loads and really manage their payments. Now, some of this same behavior is not really available to renters. While there is a CARES Act in place that covers over 90% of all mortgages outstanding and allows borrowers to either take a deferment or even lower their rates through lower their payments through refinancing, such options are not really available to renters. The CARES Act, as it's applied to renters, is not nationwide because there's no such thing as the Nationwide Rent Act, but rather done on a state level and even on a city level, and the enforcement of this is rather mixed. Now, another factor that we've seen that's been a determining factor of performance is obviously loan age. And it comes as no surprise that the loans aged 1 to 2 have performed the best, and that's largely due to the fact that that also includes post-COVID-19 issued loans, which are obviously all issued at current. The surprising, or I guess maybe not surprising behavior is that loans aged 3 to 6 months have jumped the highest, and this makes some sense. About 80% of this universe is originated for purposes of debt consolidation. These are borrowers trying to lower their debt payments and get their credit on track. And that's not a process that happens overnight. It takes months or even years. and the borrowers aged 3 to 6 months are the least far along in their debt consolidations, so this has obviously impacted them the most. To conclude the performance side, something that we've been getting asked a lot is to show how performance has been impacted across the different income buckets. And while we see that overall impairments rose about equally from pre-COVID-19 levels for all income levels, the higher income borrowers have started to come down a little bit more. Now, one thing to keep in mind is that when you adjust for some of the other attributes we spoke about, this difference actually pretty much goes away. And the main reason behind this is income only tells part of the story of a borrower. It doesn't talk about their debt loads, and it doesn't talk about how much they pay as it relates to their income. And in fact, the more comprehensive measure we found is actually payment to income, or PTI. And here we see a substantial difference in increased levels since the start of COVID across the different PTI buckets, with the lowest PTIs representing lowest payment to income rising the most. We want to conclude the NPL section with a discussion of what we've seen so far in issuance volumes. And this is largely a tale of 2 months. March issuance was actually very strong and was up 15% month over month from February and 10% year over year. April was really where we saw the brunt of the decreases, with volumes falling about 50 to 60% month over month and 60% year over year. But what is true across the board is that credit standards have substantially tightened. And in fact, going back to the volume drop, this had to do with several reasons. First is obviously borrower demand. Second is some investors not being present in the space. And third, and a very crucial part of this, is that issuers voluntarily tightened their credit underwriting standards and actually rejected a substantial amount of loans. Now keep in mind, issuers make their money off volumes. So the fact that they voluntarily tightened standards and lowered originations in order to align with loan investors is a pretty strong statement in just how they underwrite and how diligent they are about creating good loans. And we see this in the overall credit standards. FICO was up 6 points month over month in March, and an additional 8 points month over month in April. DTIs, or debt to income, were up 20 basis points month over month in March and another 90 in April. And the issuance of those top grade loans, the ones that performed the best, rose 400 bips in March and 800 bips in April to now represent nearly 2/3 of all issuance. And even as issuers raised standards, they also raised rates on those top grade loans. They raised them by 10 bips in March and 50 bips in April. So even as they're offering higher quality loans, they're also offering them with higher interest rates as further protection for investors. And with that, we conclude the online lending sector and move into non-QM. In non-QM and CRT, data is always updated on a monthly cadence, so it is only reflective data as of April 30th. The non-QM universe in our report comprises over 20,000 loans and over $8 billion of current balance. And you can see some important collateral attributes here, but the one I want to highlight is that the loans in this universe that have either stated or some version of non-income documentation is exactly 0. I repeat, these are not the non-agency loans that caused such havoc from 2005 to 2007. And for all stakeholders to be able to get a much better understanding of the non-QM market, everyone can leverage our newly formed non-QM benchmark dataset, which is available among many of our datasets in our market surveillance offering. Again, please contact our sales team for further information. Now, impairments rose quite substantially in the non-QM sector in the month of April. In fact, they were up by more than the MPL world and much more than the CRT world, and they rose by 1,450 bips since February 2020. Now, that is still below the change in unemployment, but it is the highest that we've seen of all the 3 sectors we covered. And there's a very clear reason behind this. Non-QM has a very substantial portion of self-employed borrowers or small business owners. And these borrowers have been substantially and perhaps harder hit than everyone else throughout COVID-19. Keep in mind that self-employed borrowers and small business owners weren't initially able to file unemployment claims. And in fact, that process happened 3 or 4 weeks later for them. And even as it did, the unemployment filing is much more difficult and much more cumbersome. Additionally, I think everyone knows how difficult the SBE or small business loans have been to obtain. Now, when we break this down, just as we did in the online universe, what we see is we saw a large spike in new payment impairments, but we did see an offset. 37% of all loans were delinquent last month actually cured to current. Now keep in mind just how difficult the environment was for non-QM borrowers this month. So to see 37% of those delinquent able to go back and get their mortgage to current is a very encouraging sign for what performance in this universe looks like and how dedicated these borrowers are to their homes. Now, the rate of overall increase in impairments was roughly split between an increase in delinquencies and an increase in modifications. But we have to caveat, this is actually probably understating the increase in modifications. There is a quite substantial lag in third-party reporting because in a lot of cases, the delinquent loans are either currently in trial modification or already enrolled in some brand new relief program where servicers have implemented the program, but it isn't properly reported in the third-party data. And this is really a place where dv01 shines. We are committed to data transparency from all third parties. So something like introducing a new COVID-related program should not go unreported in the third-party data that is provided for these loans. It's very clear that servicers are ramping up their relief programs much faster than they did in 2008, when this process took several years. And all data providers must be ready to fully capture all the different data as it comes to. Now, as we spoke about, the number one driver of performance happened to be the type of income that the borrowers had. The statuses that represent a likely self-employed borrower, such as 12-month bank statements or any form of bank statement underwriting, were by far the hardest hit, with impairment rates on these loans actually approaching nearly 30%. On the flip side, non-self-employed borrowers, such as those with written verification of employment or those underwritten based on assets rather than income, showed by far the smallest increase in impairments, and in fact, those rates were under 10%. The next driver, unsurprisingly, is credit score, where the highest credit score borrowers also increased the least, but we have seen substantial increases in almost every single FICO bucket. Now, interestingly enough, there were very little differentiations by DTI or by geographic regions. And the reason here is that all incomes in the self-employed universe or among non-QM borrowers have been substantially impacted. And that's regardless of what the borrower's DTI was at origination. And likewise on the state front, even though quarantine efforts vary differently among states, all the state's efforts have been very harsh on the self-employed universe and small businesses. Now we want to spend a good amount of time on LTV here, because in original LTV, while there is a substantial difference between lower and higher LTVs, we see increases across the board. And largely what we've found is that the updated LTV is a far more important driver of performance. When we talk about updated LTV, we're talking about two things. First, we're talking about the borrower's amortization or pay down of their loan. And second, we're talking about the difference in home prices between origination and today. To find that out, we've partnered with House Canary, which is a leading provider of updated home price information across property level, zip code level, and all the way up to state. And here we see a substantial difference between lower LTV loans and those loans with LTVs above 70. In fact, those loans above 70 have increased in impairments by over 3 times versus those loans below. In order to be able to better understand this updated information, both in the non-QM universe and in the CRT universe, we encourage you to visit our app where you can see updated prices for every single securitization that we have in the mortgage universe in non-QM and CRT. And finally, we conclude the non-QM sector with analysis of prepayments. And even in this difficult environment for the self-employed universe, we are still seeing that many borrowers are able to move into a more conventional form of credit and able to get a new loan and refinance. Now, this is very important considering the reduced mortgage capacity that we've seen in the month of April. And with that, we conclude non-QM and move into CRT. As before, let's overview the universe that we're reporting on here. This universe is quite substantial. We're covering over 2.2 million loans and current balances of over $450 billion. Here are some of the attributes of the universe we've covered. But we encourage all stakeholders to get a much better understanding of the CRT universe by looking at our market surveillance offering. There, we encompass the entirety of all CRT issuance. So over 80 unique securitizations across both CAS and Stacker, over 10 million loans, and over $2.6 trillion of notional value. In this report, we'll only be talking about securitizations covered by Freddie Mac because those have 1 month of additional updated data versus the CAS securitizations of Fannie Mae. Now here we see that the overall impairment rate in CRT now stands at 4.7%, up by about 360 bips since February. Now that's 1/5 the change that we've seen in unemployment. If we think about that versus 2008, overall mortgage impairments rose about 1-for-1 with unemployment. So it's very clear that today's mortgage market is not the one that caused such a crazy credit crisis in 2008. But even with that in mind, the impairment increase is very substantial relative to the credit enhancement rate that we see in CRT tranches. In fact, credit enhancement rates on investment-grade bonds can be as low as 2.5%. So that 360 basis point increase is quite substantial. Similarly, we break out the trend between new impairments, which rose by 400 bips, versus a 30% cure rate of prior delinquencies. Again, we highlight April is probably the most difficult economic month U.S. consumers have faced since at least World War II, if not earlier. And yet delinquent borrowers are really striving to pay their mortgages. And the fact that this rate is even close to in line with historical standards is just a testament to how strong the mortgage universe is today. Now we start with the performance by LTV, where we show some similar trends to what we saw in non-QM, where performance by original LTV actually rose about similarly across all buckets. To better understand this information, we encourage all stakeholders to look at updated LTV via House Canary data, which they can find on our app and in our market surveillance offering. The strongest correlation, or the strongest trends in impairments, came across FICO and DTI. Impairments for loans with FICOs above 750 increased by only about 200 basis points, while those with credit scores below 690 actually jumped by 700. And likewise on the DTI front, those borrowers with high debt-to-income ratios, remember these are not self-employed universe, those with DTIs above 43 increased by over 600 basis points, while those with DTIs below 25 actually increased by only about 100. So it's very clear that borrowers who are in a position to pay their mortgage, even in these difficult times, are doing everything they can to do so. Now, unlike the non-QM universe, states are showing a substantial difference in performance. We're seeing some of the highest increase in impairments in the New York, Florida, and California regions. But one very important caveat is that both New York tri-state area and California have a large amount of loans where their balances do not fit the balance requirements of the CRT or the GSE requirements. There are a lot of loans with balances over $500,000, And in fact, CRT represents some of the lower priced homes and lower sized mortgages in these states. Now we conclude the CRT segment with analysis of prepayments. Even as impairments have increased, lower rates are driving a substantial number of borrowers to refinance. And in fact, CPR rates hit multi-year highs in April, and they were up almost 1,500 basis points, or 15% month over month in April. And even as impairments and even as COVID continues to stay with us, with mortgage rates remaining so low, and with primary-secondary spreads poised to potentially converge, we anticipate that prepayments will continue to be high in the CRT universe for the coming months. Now, prepayment behaviors do not exactly match what we saw in impairments across FICO and geography. And in fact, we've seen some substantial prepayments across all FICO buckets except the lowest bands, those below 690. And we've seen prepayments spike in over almost every state except that New York tri-state area, which again is limited by the size of the quarantine effort in New York and the type of mortgages that we've seen in the CRT universe in this space. So now we want to wrap things up. In the online universe, it's very clear that marketplace performance has improved throughout the month of May, with total impairments falling and new impairments being well below historical trends. And issuance volume has definitely come down, but in large part that's due to issuers voluntarily tightening standards and raising rates to protect loan investors. Now, it's no surprise that COVID-19 has been very hard on the non-QM universe because of its presence of self-employed borrowers. And even with that in mind, the fact that the change impairment is still below unemployment is a very positive sign. And finally, in CRT, it's very clear that traditional agency loans are seeing very strong performance, with robust prepayment behavior and impairments at only a fraction of unemployments. Prepayments are at multi-year highs, and we can continue to anticipate this should continue in the coming months. And that concludes our closing remarks, and we now open up the floor to questions.
Thanks, Vadim. Again, if you have any questions, please feel free to use the Q&A button at the bottom toolbar, and you could just type your question in there and we'll go through them live. I think you answered this one, but are you seeing self-employment flag as one of the factors of non-performance in non-QM?
Yes, self-employment. In fact, the documentation types that we have linked to self-employment are probably the biggest driver of performance in the non-QM universe. We're seeing those loans that are underwritten based on bank statements, which are a clear indication of self-employment or small businesses, rise by far the most, and impairments are approaching 30% in some cases there.
Were you, this is just my question. I mean, you know, I think when you first took a look at the data, you were pretty surprised about the numbers in non-QM. You didn't expect them to be on par with consumer, right?
Yeah. Yeah, that's definitely something we thought might happen, but then as we're seeing just how much the self-employed universe has been hit and how much people have to think about performance of self-employed versus everybody else, we're seeing pretty drastic trends.
And when you talked about the mod understatement, this next question is about mods. I'm going to add a question to this one. So yeah. One, just what types of mods are we seeing in non-QM, and are they consistent across servicers? And then I guess is there any way to kind of have an idea of what you think the understatement of mods might be? Like what kind of ballpark?
Sure. We'll go into the first question. The vast majority of mods, and we'll cover this in coming reports, is some of the same kind of temporary payment stoppages that we've seen in the marketplace universe or the online universe. The main difference being that because a mortgage payment is substantially higher than the marketplace payment, the terms are quite a bit longer. So we're seeing a lot of 3-month forbearance plans. We're seeing some forbearance plans are going out further than that. But we are seeing a lot of kind of a 3 or more months of forbearance so far. And as it comes to the understatement, it's really hard to quantify because it's really hard to say which data platform or which third-party provider is understating by how much, but it could be in the neighborhood of several hundred basis points.
Okay. So we're out of questions from the audience right now, but I have a few questions that I think are worth chatting about. I think maybe it would be helpful to give everyone some context for, what are some of the complexities we're dealing with on the data front in terms of mapping all these modifications. We could start with consumer and then we can move into some of the stuff in non-QM, but I know we've spent many times, and I'm at a very high level talking about some of this stuff, and it feels like a brain teaser at times, but maybe just walk everyone through kind of what we're doing and how we have to kind of go through this and how, especially as things get extended and so forth, it's become a little bit trickier, and walk everyone through the complexities of all that.
Absolutely. So I guess let's start with the online universe, because that's been the fastest to ramp up modifications, and that's where we see the latest amount of data, and that's where we can see both new modifications and we can see how borrowers are starting to pay on those. In a lot of cases, these programs really didn't exist, or they existed at a much smaller scale before COVID, where you really had individual borrowers have to kind of go to the platforms, have to apply for modification, have to indicate their full status, what exactly happened, and the loans were very much written on a one-off basis. The modification programs weren't really designed to be issued en masse. They were designed to be really borrower-to-borrower specific. There was a period where some en masse modifications were offered, and that was largely the 2017 hurricane period, but it wasn't nearly to this kind of volume, and it wasn't at this kind of scale. So what we've seen and what's been the challenging part is understanding not only what kind of programs are being offered, but also how is this program enforced? When is a modification date start of? So for example, if a borrower's loan is due April 1st, but then they ask for modification on March 25th or on April 10th, how do you properly adjust the date of that? How do you deal with whether that modification covers the last month's payment or next month's payment? How do you deal with what happens after 1 month or after 2 months? And how do you deal with understanding what a borrower's payment behavior is like? Are they paying? What if they shifted to a partial payment versus shifting to a full payment? There's a lot of questions as it comes to these programs because, again, they're ramping up pretty much brand new. Now, when it came to mortgages, there's kind of two fronts here. A lot of mortgage servicers had been through the credit crisis in the past, and they had already created some modification programs before, and some servicers were really started anew, and they were really focused on either agency loans or non-QM loans, where to date we haven't really seen much delinquencies, and we haven't seen a need for mass modifications. But the truth is, in the mortgage world, mods had always been, or had largely been, a function of something being a more permanent impairment, so a more permanent change. So perhaps like an interest rate reduction or a principal reduction or extending a borrower's term. There hasn't been this kind of need to address a massive spike in unemployment, which is exactly what's been happening here. So the modifications are in some cases very new, and there isn't kind of a precedent of just being able to turn payments off almost entirely for an entire universe of loans and then not have that classify as a, as a delinquency to their credit report. So, and that involves both new types of modifications, new plans that are being offered, a lot of streamlining between servicers and master servicers and data providers and trustees and kind of everything across the board. Keep in mind also that in the prior cycle, it took about 2 years from the time delinquency started rising to the time of HAMP, where a wholesale program was put in place, and it took months or even years after that for data providers to catch up, and then for widely available loan performance to be reflective of everything. Now, this is happening in this case in a matter of weeks or months. So it becomes very important to both understand all the raw data that's being provided, start to make sense of exactly what this raw data means, what some of the new columns that are being implemented are, what does it mean if does a servicer classify a temporary payment stoppage as a modification, or do they have it called something else? Do they track it differently? How do they report it? Do they still report the borrower delinquent, or do they just keep them current? There's a lot to think about, and a lot of this is ramping up very quickly, but unfortunately investors don't really have months and they don't have years to see this behavior play out. In a lot of cases, bonds are trading week to week, day to day, so it becomes really important to have this information, kind of all aligned as soon as it comes due.
Great. We got another question in. How are you categorizing the grades across different portfolios into 3 segments that you showed in consumer?
Sure, great question. So we'd say that each issuer obviously doesn't have like a 3-tier rating system. In fact, they have quite a bit more. They have, in some cases, they go out to 7 grades. In some cases, they go out to more than 7. And in fact, there's even subgrades across everything else. So what we have to do is we have to do a lot of heuristics, and we have to do a lot of understanding what the different issuance types, what the different categories are between platforms, to be able to have one standardized definition of what we think are kind of the top grade loans, what we think are the mid grades, and what we think are the bottom grades. And that's obviously that's doing a lot of work in terms of issuer normalization to get that kind of concept streamlined across everybody. But we can't really speak to exactly what we're doing issuer to issuer because we're largely avoiding discussing individual issuers in these reports. Harry, you're muted, buddy.
Yeah, sorry about that.
Yeah.
It looks like that's all the questions that we got from the audience. Is there anything that you want to give people guidance on in terms of what we're going to be looking to do in the upcoming report in terms of new data or new analysis that we're looking at, just to give people some insights?
Absolutely. I think what you can look for in the coming reports is obviously we're going to continue to look at issuance volume, and we'll continue to see how the marketplace universe is reacting and how new issuance is kind of coming across the universe, and what some of those loans look like and how performance is happening in that universe. We're also going to be talking about prepayments in the online lending world and how borrowers are able to kind of all out close down their debt and kind of continue on their path to debt consolidation. And in the mortgage universe, we're going to continue to expand. We're going to continue to look at other flags and look at other barriers of performance. And we're also going to start seeing some initial performance of the first wave of modifications. So even as we see quarantine efforts subside in a lot of states, as we see businesses open up, we're going to start to see some behavior throughout, perhaps not necessarily in May right away, but certainly in June, we'll start to see some payment behavior as it relates to these short-term modifications. So that's something to look out for. And we're also going to have a lot more documentation and a lot more discussion about how updated home prices and how any potential change in home prices will impact how borrowers may behave and how they can potentially come out of this going forward.
Great. Well, we look forward to having another webinar and after the next report comes out. Thank you guys all for participating. And if you have any follow-up questions, please feel free to email any of us at dv01 or even just support@dv01.co. And we'll get back to you fairly promptly. Thanks for joining. Have a great day.
Thank you, everyone. Take care.